Let's get to the big story breakdown. Well, the latest U.S. jobs report adding to evidence that the labor market in this country may be losing momentum. Now, payroll growth has averaged just 22,000 jobs over the past 3 months, and Fed Chair Powell saying official data may be overstating job creation by around 60,000 a month. Meanwhile, unemployment is rising and wage growth is slowing as job gains are increasingly concentrated in just a few sectors. Well, joining me this morning is James Knightley, Chief International Economist at ING. James, great to have you. Happy holidays.
And to you, and to you.
Thank you. So we finally got that jobs figure for the month of November, so we have better insight into what's happening in terms of the labor market. But what did you make of the finer details of the report?
Yeah, I mean, the momentum clearly has weakened through the year, and that's pretty obvious for all to see. And again, when you overlay that with the comments as you made, that Jerome Powell suggests that they're overestimating, or the BLS are overestimating job creation by 60,000 a month, it really is. We are just treading water right now. Now, looking within the details, our concern, as it has been for quite a long time, is that 91% of all the jobs added in the last 3 years have come in just 3 sectors. Government, which is now losing jobs, leisure and hospitality, which is vulnerable to weaker consumer confidence, and then thirdly, private healthcare services. And that again is very vulnerable to the $900 billion of spending cuts that are part of the One Big Beautiful Bill Act. So these 3 pillars of strength are not looking quite so robust as we head into 2026, at a time when all other sectors, that you'd associate with the US economy, just haven't been adding jobs in any case. So I think it's still, the headline numbers look okay, the details still make me a little bit nervous. And I think, as we'll hear from Chris Waller again today, the arguments for a rate cut remain pretty strong as we move through 2026.
And speaking of the U.S. Central Bank, the Fed did cut by 25 basis points as widely expected. But as you hinted, there is stimulus coming down the pike here in the U.S. in 2026. But what are the implications for the U.S. economy?
Yeah, we have still got the effects of the lagged effects of the previous rate cuts to come through. We think that we'll get another couple of rate cuts this year. And we've got to remember that there is still some fiscal support, the lower taxes on tips, on overtime, social security, the SALT reappraisals, those sorts of things. They will put a little bit more cash in people's pockets. So we're hopeful that that will be enough to stabilise the situation and give a platform for growth that we can get some real nice momentum on through the middle of next year or onwards.
And of course, the countdown is on until year end, but we will be getting inflation figures out from the U.S., and that is something we'll be paying attention to alongside central bank rate decisions around the globe. So given rate differentials as well as your expectations for the Federal Reserve, what does all of this mean?
Yeah, I think there's some really interesting moves coming through, particularly in the currency markets, because we're going to have a Japanese rate hike this week, up to 75 basis points. The ECB has got a policy decision tomorrow. They're not expecting to change, but they are likely to signal that their next move may be higher. So we've got this interesting contrast where the US and also the UK is still cutting interest rates, but other developed markets are now actually thinking about raising them. So in that environment, we're looking for the dollar to continue its softening trend. So one of our key calls for next year is the euro-dollar rate to go to, say, 122, for example.
And of course, zooming in on the Federal Reserve, I do want to ask you about its balance sheet. So there have been questions regarding its balance sheet moving forward, but what do you make of some of the conversations out there when it comes to what they're doing?
Yeah, I think, it also comes to this point that Scott Bessent, the Treasury Secretary, has made it clear that he feels the most important interest rate in the US is that 10-year yield. Now, right now, we're okay. We're around 4.16, as you said. But the risk is in an environment where you've got fiscal deficits continuing to rise, this prospect of a potential $2,000 tariff dividend payment coming through, that fiscal challenge remains there. There's still some lingering concerns about inflation. So in terms of the balance sheet, it wouldn't be surprising to see the Fed potentially, if it's more aligned with the White House, to start contemplating potentially even expanding its balance sheet once more as we progress through 2026, if that 10-year yield does start to go under upward pressure, because that has obviously knock-on effects on mortgage rates and corporate borrowing costs as well.
And finally, James, before I let you go, I do want to ask you about your 2026 outlook for economic growth. What is in your forecast?
Yeah, I think we're looking for something pretty similar again to what we saw in 2025. So it looks as though we're on course for about 2% growth this year. We're going to get the third quarter number next week. And we're looking for something similar next year as well. Largely because we have got that support from the monetary policy side. We've got a little bit of support from the fiscal policy side. And hopefully that will start to stabilise confidence both in households businesses, and as I say, will deliver the platform for stability. And we're looking, as I say, 2% growth with 2 Fed rate cuts next year and a little bit more dollar weakness.
Okay, James, always great talking to you. Happy holidays, and thank you so much for joining us.
Thanks a lot.
Thank you.